Hi, do you know how to look for long signals that indicate a stock has bottomed out? Today, SlashTraders will show you how to use the bull put spread screener to find heavily undervalued stocks that you can trade high probability and high return bullish options. We'll talk about 5 key points today. 1. What is a bull put vertical spread? 2. Why bull put spread? 3. What are the key points to profitable bull put spreads? 4. How to use the bull put spread screener to find the best bullish trades. 5. The best bull put spreads right now. A bull put vertical spread works by combining a short put and a long put at different strike prices that expire at the same time. The put vertical spread is profitable if the underlying price goes up before expiration. Let's review the profits analysis of selling and buying put options. We receive a premium when we short a put option. If the underlying price goes up, we make a profit. Although a naked put is easy to execute, if the underlying price goes down, the maximum loss is unlimited. We pay a premium when we long a put option. If the underlying price goes down, we make $100 for every $1 drop. But if the underlying price goes up instead, the value of the put option expires worthless. When we combine a short put and a long put at different strike prices, we create a put vertical spread. Since we want to trade bullish, the strike price of the short put will be higher than the long put. Compare this to a short naked put. A bull put spread can limit the maximum loss if we are wrong about the direction. If we are confident about a bullish outlook, trading a short bull put spread has higher leverage than buying stocks. We can use AAPL to compare the differences between trading a bull put vertical spread that expires next month and buying stocks. An at-the-money bull put spread has a 54% chance of success, while buying stocks has a 50% success rate. If AAPL price goes up by 10% in 41 days, we gain 10% profit from a stock trade, while a bull put spread gains 73% return. If we are wrong about the price direction, the bull put spread loses 100% of the buying power. Let's look at some key points to trading profitable bull put spreads. When selling put spreads, we have a positive delta, so we want the stock price to go up to decay the option value, then we can buy to close the trade. Delta is the changes to options price with respect to changes in the underlying price. A positive delta trade is profitable when the stock goes up, and the trade loses when the stock price drops. If the stock price stays above the short put strike, we can wait for the options to expire worthless for a profit. The maximum loss of a bull put spread is the width of the puts times 100 minus the premium collected. The buying power used equals the maximum loss. So when the put strike's width stays the same, a higher delta leads to higher premium, lower maximum loss, and higher returns. Let's look at two bull put vertical spreads with the same $5 widths. When the short put is at 50 delta, the maximum return is 73%. When the short put is at 20 delta, the maximum return is only 15%. The bull put spread screener uses historical chart analysis to find bottom-out stocks that have a high probability of an upward correction that we can sell bull put spreads to open. We want to find heavily undervalued underlying that have a high probability of going up. The option screener uses fundamental analysis to calculate a fair value of the underlying, then compare that with the last value to find the potential upside of the stock. When the upside is greater than 30%, we have high confidence in the bullish outlook. We also use chart analysis to see the short-term movement of the stock, whether the underlying is in an uptrend or a downtrend, so we can time the market accordingly. When the trends column turns green and shows uptrend with a number, we know the stock price has been bullish in consecutive days. Our screener's unique long signal days uses chart analysis to find the long-term trends of the underlying. When the long signal days column turns green and showing the number of days has passed since the last bottom out signal, we are confident the stock is ready to correct in a bullish direction. We can combine the 3 bullish signals in the screener to execute high probability bullish trades. The screener also helps us find high return on capital 50 delta at the money bull put spreads. Let's pick the highest probability and high return bull put vertical spread entry points. By combining upside trends and long signal days, we can see BABA is heavily undervalued with 79% upside. Trends tells us Alibaba is currently at the start of an uptrend. The long signal days column has turned green since 12 days ago, so we can be confident of an upward direction. Let's double check the BABA price trends by analyzing the stock charts. The most recent low point of BABA happened 12 days ago on 23rd of August, and the stock has been trending upwards ever since. Considering the stock is heavily undervalued, we can be confident of a bullish outlook. We can sell an Alibaba bull put spread option that expires in 41 days. If the BABA stock price does not fall before expiration, we can profit 31% from the trade. Now you know how to use the bull put spread screener to find bottomed out stocks that are trending upwards. Remember to use the screener often to find the best bullish put spreads to sell and profit from the rising trend. If you enjoyed my video about trading options, please like and share my videos and subscribe to my channel. Thank you.